want to welcome everyone to the GPS Wealth Management State of the Markets update. We're going to be looking at some key data from 2017, as well as taking a look at what we can expect for 2018. So thanks for joining us. All right, guys, this is our required disclosure. Take a second to look at that. All right, let's start out with an overview of where we are on the S&P 500. So the S&P 500 is an unmanaged index of the greater U.S. Market that you cannot invest directly into the index. If you'll take a look at, this is going to take us from, let's see here, I'm going to set this up. No, hold on a sec, guys. All right, so we're starting at 2000. We're going to come out of the tech bubble. We're going to have 9/11. We're going to have our war. This is going to build the real estate, the credit bubble. We're going to enter into the Great Recession, and then this has been our long ride into recovery. Starting at the end of 2016, we had our Trump election, and 2017 has been a good year overall. And now what we're looking at is right about mid-February on this chart. And you can see this correction right here. So let me keep on. All right, so what happened this year? The financial world is incredibly complex, and these days they were bombarded with dramatic headlines. There's a lot of different opinions. So the goal today is to educate you about some factors we, as well as some financial experts, are watching. Of course, it would be impossible for us to cover everything, but I'm going to try to cover a lot of the relevant factors. And just keep in mind that past performance does not guarantee future results. So I'm going to focus on trends that may guide in the decision-making process when it comes to investing. And so what we're going to talk about today is what happened in 2017, what are the other factors affected the market, what's on the horizon, and what do financial experts expect for 2018? All right, in 2017, the market soared to new highs on solid economic expansion. The S&P 500, the Dow, the NASDAQ, all repeatedly broke new records. And with record low volatility, the bull market just kept on charging. President Trump's inauguration in January further encouraged already growing markets. Solid market performances has helped push the Federal Reserve to raise rates 3 times in 2017. During the summer, some investors expressed some concern over Hurricanes Harvey and Irma, rising tensions between the U.S. and Korea. A focus on some of these market fundamentals became crucial, and keeping a perspective helped investors capitalize on the market's upward momentum. In December, the House and the Senate reached an agreement on this tax reform bill that some supporters claim will help businesses and boost gross domestic product, so GDP for short. On December 22nd, President Trump signed this bill into law. So finally, despite posting losses in the year's last week of trading, all major domestic indices still ended up higher than where they began at the beginning of 2017. So good news there. I'm moving this along. All right. So what we're looking at in this particular slide is the analyst predictions at the beginning of 2017. Okay, so at the end of 2016, a lot of the well-known analysts will give their predictions for the upcoming year regarding the S&P 500. So what we can see is they all predicted that the index would grow, but even the most optimistic target was still more than 200 points below actual results. Ultimately, the S&P went far beyond these expectations and closed the year with a 19.4% gain. The S&P wasn't the only domestic index that performed well. The Dow increased by 25.1%, and the NASDAQ was up 28.2%. So a great year overall. So what we've seen, 2017 brought significant growth to the markets, but let's dig into some other factors that contributed to the performance. So we're going to be looking at the labor market, housing, consumer spending, corporate growth, as well as inflation. 2017 was a solid year for all American workers. The unemployment rate had dropped from 4.1, which was the lowest rate of unemployment since before the dot-com bubble. In December, we hit the 87th consecutive month of job growth. While the labor market still experienced some volatility due to Hurricane Harvey and Irma, the unemployment rate still remained at a 17-year low. With that said, wage growth has been relatively sluggish, hovering around 2.5% for the year. So still sluggish, but making some progress. So what I want you to understand about the scope of growth in the labor market and where these jobs are coming from can be very eye-opening. The total private payroll charts reveal that the economy lost 8.8 million jobs during the Great Recession. But during the recovery, we have gained back twice as many, with 17.1 million new jobs created between 2010 and 2017. All right, so where did these jobs come from? Industries related to information, financial services, professional and business services gained 5.1 million jobs. However, on the other end of the spectrum, we've lost 100,000 jobs in the government sector since 2010. 2017 gave us a lot of positive insight when it came to home sales. The last data available in 2017 comes from November, and it indicates that the industry is performing very well. In November, both new and existing home sales were the highest they'd seen in the last decade. Year over year, existing home sales were up 3.8%, and prices increased 5.8%. In that same period, new home sales jumped a massive 26.6%, while prices only grew at 1.2%. Even with this huge jump in new home sales, they still represent a lower percentage of home sales than in the decade before the housing bubble burst. In other words, new home sales still have some room to grow. In fact, some analysts believe new home sales have a bit of growth potential, which could benefit the home building industry. Overall, as the economy picks up speed, the housing industry helps to foster growth. So think of it like this. As people buy homes, they're typically buying new appliances, they're buying new housewares, they're fixing up their old house they're fixing up the old house to buy the new house. So there's a lot of money momentum whenever housing is solid. So that typically lends itself to fostering growth. All right, so what we're going to be looking at here is personal income and consumer spending. And consumer spending accounts for more than 2/3 of our nation's GDP. So the health of individuals' financial lives is extremely important to understand when we're analyzing economic strength. Judging from recent data, consumers are starting to feel the effects of economic growth and increase their spending in response. So as of reports from December 2017, consumer spending had increased 4.5% year over year. Incomes had also gained during that same time in 2016. This chart gives us a month-to-month breakdown of how much consumer spending and commercial and personal income has increased over the recent months. With the exception of personal income staying flat in June 2017, which is right here, both measures have been on the rise for over the year. So, but what I can say is November's data does give us one potential challenge. And what you're going to see is spending is increasing faster than incomes. As we all know, spending more than you make is a recipe for debt. And so currently debt to income ratios are near their lowest in the past 35 years. But this is one detail that we're going to need to keep watching to just see how consumers are handling this debt. But based on this data, consumers are feeling very confident, and that's a good thing. All right, what we're looking at here, this is an article that I pulled from the Wall Street Journal, okay, and it's kind of an interesting outlook. Some notable items I pulled out of the article is, so 2017 showed a surging stock market, right? And Americans, as a result of that, are saving at an all-time, it's a 12-year low. So as stock prices go up and job prospects are looking stronger, household net worth is going up. There's a sense of wealth, right? And so when people feel wealthy, they tend to spend more money and save less. And so this is interesting. Let's see, this next graphic I'm showing you, I pulled this from CNBC, but we're calling this the wealth effect. And basically what it is, it's a comparison of when, however the stock market is performing versus the personal savings rate. So as I look at this, you'll see these three white circles. All right, so the black line is the stock market, and the red line is the personal savings rate. So you can see continuously, as the stock market is strong, people tend to save less. When the stock market is strong, people tend to save less. Here you see that the stock market crashed. This is our recession, and people started saving a whole lot. And then here we are in our current situation. The stock market is rallying, and the U.S. savings rate is dropping significantly. So that's an interesting trend to keep your eye on. Okay, in 2017, businesses continued to grow as we've seen over the past several quarters. And during the third quarter of the earnings season, which was the last quarter we have data for, 72.8% of companies in the S&P 500 beat their expected earnings, and 68.1% of them beat their revenue expectations as well. Overall, analysts anticipate these earnings will be 8.4% higher than in the same time last year. And while data for the final quarter of 2017 isn't all finalized, the estimated earnings growth is even higher, and that's expected to be somewhere around 11%. So if you look at the chart, you can see that earnings have grown since the third quarter of 2016, and analysts still expect them to rise through the second quarter of 2019. So good news there. All right, let's talk about inflationary trends for a minute. Inflation is the general rise in prices of goods and services, okay? So one of the key indicators of the economic well-being of our nation. So through the relationship between inflation and the stock market is complex. Generally speaking, stable and modest inflation is better for equities than high and volatile inflation. So if you take a look at the box in the middle of the chart, you're going to see several acronyms. CPI stands for Consumer Price Index, and the headline CPI is the most popular measure of inflation. The federal government puts this data out and tracks these trends in a large number of goods bought and sold in the U.S. On the other hand, the core CPI below it, it's going to strip out food prices and fuel prices because those tend to be more volatile on long-range inflation trends. So you can see that the brown CPI line jumps around much more than the yellow core CPI line, and that's because food and energy prices tend to be volatile in the short run. Though the past doesn't always represent what's going to happen in the future, a sudden run-up in prices is often presaged by or accompanied by a recession. So note, if you look at this graph here, you're going to note some inflationary spikes during the 70s, which was the oil crisis, and in the 1980s recessions. So, all right, so 2.2%, the headline CPI as of November 2017 was well below the 50-year average. In addition to the core CPE deflator, okay, CPE stands for personal consumption expenditure. All right, so in addition, the core CPE deflator, which the Federal Reserve uses as its primary inflation measure, was less than half of the 50-year average. At 1.5%, the core CPA deflator is also below the Fed's 2% benchmark. Okay, so what's happening in the big scheme of things is interest rates are becoming more and more of a factor. So let's just hear me out on this. The Fed has a mandate to foster maximum employment and to foster price stability. They believe a 2% interest rate or inflation rate can support accurate financial forecasting and decisions while preventing any harmful deflation. So keep in mind, February 5th, the new Fed chair was just sworn in, and his name is Jerome Powell. So there's going to be some movement relative to some of the things that are going on there. All right, so what we're looking at in this graph is consumer sentiment. and everybody seems to be really confident that the U.S. economy is on track. Yet we know that the stock market doesn't always follow the economy, and one of the major indicators of our economic health is consumer sentiment. So essentially, this is a survey that asks regular Americans how they feel about the economy and their financial prospects. So it's an important indicator because sentiment has a strong relationship with consumer spending. So consumer spending drives 2/3 of our economic growth, as I mentioned before, and we are a consumer-based economy. So that the more consumers spend, the more we have velocity of money, and so forth and so on. That's another topic we can talk about later. But sentiment can also be connected to market performance, but in a more complicated ways than you can expect. Consumer sentiment is typically a rational reaction to a strong economy. However, it can also signal irrational investor exuberance when prices climb to unsustainable levels. So some interesting things going on in that aspect as well. Historically, though, recessions may follow periods of high consumer sentiment. What we see, and not always, but what we see is recessionary periods on this chart. They're going to be the vertical shaded areas. Is that always the case? No, but you can see that, okay, so it wasn't the case in 1977 and 84 and 2004, but on the other hand, it did happen in 72, 2000, and 2007. So in October 2017, consumer sentiment hit a high of 100.7. That's the highest reading since 2004. Though consumer sentiment did fall slightly in November to 98.5, and then in December it was 96.8. It still remains in positive territory. Household finances help raise consumers' attitudes on the back of a strong economy, low unemployment rates, market highs, like I mentioned already. Later in this presentation, I'm going to cover some reasons for this high sentiment and why we should stay optimistic about the markets. All right, what we're looking at here is, I just had to interject this because this is what this is called the cycle of market emotions, okay? If you can see this, this is the wave of the economic cycle. And so people tend, so if you can imagine, we're climbing up in a positive bull market. So people are optimistic, excitement is starting to go up. There's a thrill about my net worth is growing. I feel good about my job prospects. And you notice that it's this, here's the everyday investor, get me in, buy me more, everything's up, I want all in. And I actually have been hearing that quite a bit. But the question is, I want you to take note of this right here. Successful investors recognize this is a point of maximum financial risk. So there is some movement in the market, which we've experienced at the early part of February. So then you start to potentially get into some anxiety. If the market truly was to correct for any duration of time, you know, denial, there may be fear. Is this a real hard correction? What's happening? What should I do? Anyway, if it's a replay of any long-term correction, people get very nervous, especially the closer you're getting to retirement. And the worst thing someone can do is sell and get completely out of the market when the market is at the bottom. So on the other hand, successful investors recognize that this is an opportunity. So if you have time in the market, okay, if you're looking for long-term growth, that would be the time potentially to reallocate and find new opportunities in the market. So I did want to just bring that up to you. All right. So looking back at our 2017 predictions back then were, okay, so this was before we get to 2018, and we're going to take a look at 2017, right? So last year we imagined potential headlines that could happen in the future, and they gave both optimistic and pessimistic views. From a positive perspective, we imagined that the stock market would perform well, businesses would invest in the U.S., President Trump's economic policies would accelerate the economy, right? We're happy to say that this has been the case in 2017. The market continued to hit new highs, and new economic and tax policies have helped drive business. On the other hand, we've also got some potential risks that were not manifested, which is great. Now, remember, I'm talking about 2017. The European Union is still intact. We avoided potential trade wars, and of course, inflation is still low. By following these market fundamentals and no knee-jerk emotional decisions, we maintained an optimistic outlook through the year. Come on now, let me get my thing going. All right. All right, so what's on the horizon? We looked at some of the factors that affected the market in 2017. Now let's take a look at some of the headwinds and tailwinds that we could be facing as we approach 2018. Okay, 2018 brings some new questions regarding what the future may hold. January was steady as she goes, very optimistic. Nothing had really changed, but then here comes February. Several things made people a little bit nervous, but some of the positive outcomes are the new tax bill spurred economic growth, tensions with North Korea seem to be easing, and Europe continues to strengthen despite any Brexit issues. Okay, on the other hand, what we were facing was potentially 5 years from now, we could have a different picture, right? So there's still some potential risk out there that could create headwinds to our economy, and the outlook becomes more concerning if these things were to come together. So let's suppose Trump is indicted for obstruction of justice. That's one thing. We could have, right now we're facing some new sanctions on North Korea, which North Korea is not liking at all. So that just happened right as we're ending the Winter Olympics. So that's an interesting thing that we're going to need to watch. And then finally, you know, an additional item might be if the European Union is indeed over. Of course, nobody can predict the future. And so there is a bit of noteworthy political uncertainty for 2018. But here's the thing, it's very important to take a look at what's really happening in the economy and what the data is showing. So whether it's real or imagined, headlines are only helpful if we take the time to think about it critically. You know, what does it really mean? Is this a bunch of media talk, or is it really, does the data support it? And so anyway, it's going to be key to focus on these fundamentals, avoid any emotional reactions, look at the data and not just these headlines. All right, if you followed me at halftime last year in 2017, you'll recognize these indicator speedometers. But again, I'm taking you back to December 2008. Okay, the market started to crash in September of 2008. So we're 3 months into it at the time that this snapshot is taking. So if recessions trigger bear markets, right? Let's take a look at these, and what you're going to see is out of the 20 indicators, what they do is they forecast pressures on the economy and the financial markets looking forward for the next 3 to 6 months. So out of these 20, we only have 3 positive green ones during that time period. So green is going to create a tailwind. It's going to help push the economy along. Yellow is going to be cautionary, and red is the headwinds that put brakes on our growth. So where you see lots of red on the board, the economy is in serious trouble. The housing market is in deep red. Volatility is high. Global economic outlook is negative, and business spending is dropping. All right, so that's where we are as of that point. Now, what this one is showing us is right as we're going in after Trump was elected, and he has not been inaugurated yet. So, so we're looking at the beginning of last year, January. You see a lot of green on the board. The U.S. economic outlook is good. Consumer confidence is high. Corporate profits are growing, and you're seeing a lot more positive signs. So overall, 16 out of the 20 leading financial indicators reported positive and strengthening numbers, and there is no red on our board here. Now what we're looking at is at the end of the year. All right, so we're December 2017, have not launched into 2018 yet. The only negative on the board comes from geopolitical risk, and there's no surprise there. We've had this intense relationship with North Korea. On the horizon is this Russian collusion investigation. Those things are causing some uncertainty, right? But just as in January 2017, 17 of the 20 speedometers are still green, and those reflect economic strength and a positive outlook. So throughout the year, corporate profits rose, the global economic outlook has improved, and the U.S. economic outlook has remained strong. The yellow gauges are areas where analysts have some concerns, and we're going to continue to watch developments in these areas over the next 3 to 6 months. So while there's still room for improvement in 2018, our economy is still showing compilation of strength and potential growth, especially when you compare it to 2018, right? So now the past can't predict the future, like I've always said, and financial markets don't always act in unison with the economy. But barring any unexpected economic shocks, we're pretty confident the economy will grow and continue to grow into 2018. All right, so I just wanted to put this out there. So Barron's released an article from the Eurasia Group recently, and this is maybe about a month old, listing their top 10 geopolitical risk. I'm not going to get into a lot of details on these, but I just want you to be aware of them. So we have the U.S.-China conflict, particularly regarding trade. Okay, so in addition to that, any U.S. or international missteps or misjudgment regarding North Korea, Syria, Russia, Iraq could provoke some serious conflict, right? The last thing we want is to go into any type of war. Okay, number 3, a global tech war. So what this is an interesting place right now. Global competition and standardization of artificial intelligence and supercomputing. The big question is who are we going to trust? And does anyone have the capacity to launch global viruses that could attack all of our cybersecurity? That's a big deal, okay? And especially with some of the trolls and things that are coming out of Asia and Russia at this point, and even Iraq. All right, Mexico and NAFTA renegotiations. Just recently, the Mexican president and President Trump just had some strong words on the phone, and in fact, he canceled his trip to the U.S. So interesting things that we're going to be watching relative to Mexico and Canada. All right, we also are facing some stress in the U.S.-Iran relations regarding nuclear weapons, human rights, terrorism, those kind of things. Clearly, there's a decline of institutions and anti-establishment, so that is creating some challenges globally as well. And then you've got our protectionism mentality, and then UK and the Brexit, anyhow. But these are some key things to keep your eye on that are driving that red speedometer in our leading indicators of economic growth. All right, so the markets have rallied since the 2016 presidential election, reaching one high after another. But the question is our investors too euphoric? Are equities overvalued? I get that question a lot. So let's take a look at this chart regarding fair value, okay? First of all, PE ratio means the difference between a company's price per share, or P, its price, and its earnings per share, which is the E. So the higher the PE ratio, the greater the difference is between what investors are going to pay for a stock and what the company's actually earning. So high PE ratio means stocks are relatively expensive compared to what they're earning per share. If you look at the middle dotted line in this chart, you're going to see the average PE ratio is 16x. In other words, over the past 25 years, stocks have averaged a price per share of 16 times earnings per share. In the Great Recession, the PE ratio was far below the average line, whereas it was high during the dot-com boom. So by December 31st of last year, the PE ratio was at 18.2x, which is above the 25-year average, but it's still within one standard deviation above average. So that top line is the standard deviation line. So once you start to cross over that, then you're getting into a little bit more of what we call an outlier. So we need to keep an eye on that, okay? However, I do want to say that with the slight correction that happened at the early part of February, the market is starting to try to normalize. So we're definitely keeping our eye on that as well. But the deal is that there is a term which I'm sure you probably have all heard. It's called FOMO, fear of missing out. So as I mentioned in that other graph, the market cycle of emotional investing, retail investors are in this fear of missing out, right? So they want to jump in when prices are really high. So I am encouraging rebalancing, really taking a look at your market allocations at this point in time and understanding what your whole potential as well as risk is in your personal portfolios, including your outside accounts as well as your 401k. All right, what we're looking here is I want to put these all into context. So we've established that the PE ratio is higher than the historical average, but is still within one standard deviation, okay? But if you look at this more closely in context, you can see that the current PE is pretty normal for times when inflation is as low as it is right now. In fact, since 1871, anytime inflation has been between 1 to 2%, the S&P 500 PE has been just over 20. At our current low inflation levels, then, in theory, the 18.2x PE ratio is not actually too high. But I want you to think about this in this terms. If you're familiar with, if you were around and old enough to remember the 1980s when interest rates were extremely high. So when rates are high, prices drop. It's almost inverse relationship. When interest rates are low, prices can be higher. And so it has to do, in the case of the mortgage industry, for example, affordability. People need to be able to afford the payments that they're going to have. So it's real similar in when interest is low, prices are higher, and vice versa. So just a little correlation there. All right, let's look at our forecast. And so we're going to be looking at just some things that has been predicted going into 2018. As I discussed earlier in the presentation, inflation is below the 50-year average, right? So, but what does that mean to 2018? So in this data that we're looking at, the Consumer Price Index reveals that prices on the rise. They are on the rise. So between December 2016 and December 2017, the Consumer Price Index was increased by 2.1%, which is above the Fed's target rate of 2%. When you look at the less volatile core CPI, and remember that doesn't include food and energy, it increased by 1.8% during that same period. The CPIU is the CPI value for urban consumers, and so now they're going to cut out the rural population. So there's all kinds of ways to maneuver with these numbers. So anyway, so what we established earlier is inflation is increasing, but at a relatively reasonable rate. The difference comes when you look at the last 3 months of 2017. So during the fourth quarter, the CPI increased by 2.6% at an annualized rate. So what does this mean? It means that inflation increased as the year went on. In 2018, we also expect this trend to continue. Prices for housing and services have been increasing. Producer prices indicate that more inflation may be on the horizon, and some analysts believe we could hit 2.5 or even higher by the end of the year. And in relation to that, I mentioned to you earlier that Jerome Powell was just sworn in as the new Fed chief on February 5th, and he mentioned that due to this economic data that initially we were expecting 3 more rate increases for 2018, but he's indicated that there may be more rate rises, which means the market got very nervous. So let's take a look at some more deep. I'm going to dive into this a little deeper. So, all right. So in December last year, the Federal Reserve raised interest rates for the 3rd time. Currently, their target interest rate is between 1.25% and 1.5%. And so the Fed currently predicts that the monetary policy changes occur gradually, then economic activity will expand at a moderate pace, and labor conditions will remain strong, and everything's going to be great. You know, that's what they're predicting. So the Fed also said originally that they plan to increase rates 3 times over 2018. Ultimately, Raising interest rates are a sign that the economy is doing well. But what happens when interest rates rise? So according to our chart here, you can see, okay, so here we have this dotted line right around 5%. All right, so the dotted line represents a 5% yield on the 10-year Treasury. And 10-year Treasury seems to be really the go-to measurement. Now, if you take a look at the brown diamonds and where they are, okay, so you're going to notice that we've got a concentration of them up here when interest rates are below 5%, and they're on the bottom half when interest rates are above 5%. So if you look at this right here, there's a positive relationship between yield and movement and stock. When interest rates are below 5%, people tend to go towards the stock market. When interest rates are above 5%, they tend to go more towards bonds. Okay, so that's basically what that's saying. So in other words, history shows that we may be able to expect the markets to rise as rates increase, as long as the Fed doesn't raise rates above 5%. So we're well far away from that. So if you just look at the interest rate relationship to equities, that's pretty positive, but who knows how long it's going to take the Fed to make these movements. We don't know, right? All right, so moving forward, after its December 2017 meeting, the Fed releases predictions for GDP and unemployment for 2018, and as you can see, they predicted GDP will continue to grow steady at a moderate pace, and they expect that unemployment will drop even further in the next few years, hitting 3.9 or so in 2018. So I'm going to keep on going here. So those numbers are looking pretty positive as well. All right. Now, what we're looking at with this one is the 2018 forecast. So at the end of the year last year, basically what happens is we get these experts that are forecasting domestic equities of the S&P 500 and what they think is going to happen with the S&P through the year. All right, now these targets aren't all mine. They're experts and different analysts, and as you can see, the 2018 estimates cover a 750-point range from 2350 at the low end up to 3100 at the high end. And I'm just here to tell you, even the experts, they don't know which way it's going to go, right? So they all have different opinions. But while they give a range of results, one trend is consistent, and that is that all but one strategist is predicting that the S&P will continue to rise in 2018. In fact, just days before the year started, a number of strategists even increased their estimates for the 2018 growth. However, of the strategists that are included on this list, the average estimate for the S&P would be 2863, which indicates a 7.1 growth for the year. And these are strong returns, even though they're less than half of the 19.4% growth that we had in 2017. 7.1% is no slouch. So anyhow, let's see. So there's no way to tell the future, as I was saying, and you can see by these estimates from all of these analysts, the market really could go either way. But the general consensus is that we're going to have forward movement, providing no major upsets happen in the geopolitical environment. All right. So we've gone over a whole lot in this presentation right now, but the one thing I want you to take away is you have to remember this: emotions have no place in investing. And over the past 9 years, we've weathered many financial storms. I mean, including the Great Recession, we've had some global pandemics, there's been terrorist attacks, all kinds of things going on. But even after all of these tests and the volatility and those type of things, the market still continues to grow and create opportunities. And what we're looking at in this particular graphic is the yield curve. The yield curve is a line that plots interest rates of bonds at a set point in time, having equal credit quality, but different maturity dates. The most frequently reported yield curves compare the 3-month, the 2-year, the 5-year, the 10-year, and the 30-year in Treasury debt. The yield curve is used as a benchmark for every other debt in the market, such as mortgage rates and bank lending rates, The curve is also used to predict changes in economic output growth, okay? So at the time that this was first put together, the 10-year was at 2.4. When we hit this bump in the road in early February, the 10-year jumped up to 2.3, and as of this recording, it's at 2.86. So anyhow, the bottom line is the logic is interest rates. A rational investor is going to decide, is it better to put their money in bonds or is it better to put their money in the stock market? And right now, because the yield curve is still down, it's below 5%, that drives investors towards the equity markets. Come on. Okay. Whoa. So what happened on Friday the 2nd? Is it a market correction? Is it not a market correction? Okay, some analysts say that when the indices drop 10% or more, that defines a market correction. Okay, so what happened on Friday the 2nd? Rising rates. So I mentioned that already. The new Fed chair indicated that he's likely to raise rates more than originally anticipated. As I said, initially we were expecting 3, and he's made pretty serious commitments to raising it more than that, 4 times, potentially even 5 times through the year, providing the data supports it. And data coming out is showing that we can support higher interest rates. Okay, so as a result of that, those institutional investors that use leverage, which is debt, in their products and investment strategies, they got very concerned about rising rates, because rising rates negatively affect those types of products and strategies. So then they started selling off these investments for fear of getting caught holding the bag, right? So as they started to sell, then you've got what we call this programmed algorithmic computer trading schemes that they're programs that when the market acts certain ways, that it will automatically trigger more selling, okay? And that created more selling of the market. And so you saw those days when we dropped over 600 points, over 700 points, over 1,000 points in the Dow. Okay, so that's what those are. I mean, some of these things are all playing together, hand in hand. On top of it, then, now you've got the retail investor psychology jumping in, as I showed you earlier. What, is there fear? Do I need to be getting out of the market? Is this just a blip? Is it the real deal? What's the scoop? So some people were taking advantage and buying in, and a lot of people were getting out. Okay, and anyhow, another thing is, for folks that don't have this data regarding PE ratios and standard deviations and whatnot, the question is a fear of equity overvaluations. And so they may have started jumping out because it feels like the market is overheating, okay? And then finally, with rising rates, there's this fear of this national debt, or national debt interest payment. So we all know, and let me back up. So this is related to the Tax and Job Act that was just passed at the end of December, which is expected to negatively impact the national debt, right? So this is a finance tax cut, if you will. All right. So rising interest payments will negatively affect the U.S. balance sheet. So this is a bond market bear, where we have to find treasury buyers in order to make up the difference on the shortfall for the budget. And so all this time, China's been our primary buyer of U.S. treasuries when we needed to generate more cash. And so China may not be willing to do this because of some of the trade, I don't want to call it the trade war, but as I mentioned before, some interactions between the U.S. and China regarding trade. So we're not sure how willing China's going to be to buy more debt from the U.S. All right, and then let me just close with some of these. What actions should you take? First of all, keep us in the loop with any important life changes. So if you happen to have any significant things going on during a time of market volatility, that's a major concern for us. We want to make sure that you're protected and that everything is in place the way it should be. you need to tell us if you have any concerns about your investments. So if there's anything going on and you're not sure if you're where you need to be relative to any major upsets, and remind you, if people knew when the market was going to drop and correct, I mean, we'd all be wealthy and rich, right? So nobody really knows. So you have to be prepared for any uncertainty into the future. And then finally, make sure that your legal and financial documents are up to date. So this is getting more into the world of financial planning, but you definitely want to do that. Okay, and then as far as us, it's our goal to keep you informed through regular communication such as this and ongoing smaller lessons and workshops and things of that nature. We want to manage your investments according to your personalized strategy and risk tolerance and risk scores as well. So I know, like as I mentioned before, some folks have been asking to be more risky. So just if that's your case, let's discuss that in more detail. And then finally, it's our goal to stay on top of these changes in the market environment and make prudent adjustments when they're necessary. Clearly, we want all of our clients to be, take advantage of opportunities and those kind of things of that nature, but we do need to be prudent in any type of recommendation. So let me just end with this. Knowing is power, and getting yourself educated and understanding the dynamics of the broader market, macroeconomics, microeconomics, social issues, without getting political. It's in your best interest to have a well-diversified plan of action, not just diversified investments, but plan of action, so you can maneuver not knowing what the future holds. So if you have any questions regarding your personal situation or investments, please contact our office to set up a time to discuss an individualized plan of action for you. Because what's right for the guy sitting next to you in the office may not be what's right for you, okay? So give us a call at 832-689-5746, and be sure to follow us on YouTube and Facebook and stay informed with what we have going on. So again, appreciate you joining us and look forward to next time. Thank you.